Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting. Welcome to Charts and Chat for March 31st of 2024. Starting the chart pack this week, want to get level set on the current set of expectations out there. These are economist forecasts as reported to us by Bloomberg. See here, we've got the economic growth consensus forecast for 2024. And then over here, we've got the inflation forecast. The CPI is the Consumer Price Index. GDP, as we know, is gross domestic product. And so what we find is actually very interesting. So the latest reading on consensus growth in the economy for 2024 is 2.2%. And you can see that that's come a long way since mid-July last year when expectations were pretty grim. And coming out of, June, that there was a feeling that we were really going to have a real slow year. And this is that debate that we were having last year about soft versus hard landing, recession, so on and so forth. That really hasn't materialized. And you can see here this rather stark rise in expectations from that point forward. And really over the last 9 months or so, the expectations have really increased at the same time that we've seen kind of a similar increase in inflation expectations. So looking at that trough here in July and mapping that over to this chart, the inflation forecast was moving higher, and it really kind of almost accelerated here at the beginning of this year as expectations for what they call higher for longer really began to crystallize. And that was the feeling that we had relatively strong economic data, and the Fed was not inclined to reduce rates. Remember, coming into the year, the expectation was that the Fed was going to reduce rates about 6 times this year, and now that's been ratcheted down quite a bit. And we do feel like, we're going to be stuck with higher rates for longer. But at the same time, economists are feeling that we're going to be stuck with a little bit higher inflation. Again, 2.9, this is 3%. So, and just to put this in level context before we move on, that from a financial planner's perspective, for a long time, the benchmark inflation rate to use was about 3%. And it was only over really the last decade or so that a lot of those inflation expectations that were built into financial plans and asset growth and so on and so forth was brought down. But 2.9 is not out of line with history. Obviously we want to go into all of this eyes wide open. This is, increased at a pretty heavy clip over the last couple of months here. And so, I feel like we're going to, that this is going to begin to kind of cement pending new information that we have in the market. We have a chart that plots in the white, we've got PCE, or personal consumption expenditures. This is the core index. So this is the Fed's preferred measure of inflation. And this is year-over-year data you can see here in the white. And in the blue line, it has U3 unemployment rate, which is the unemployment that is reported on a regular basis. And you can see what's interesting here, the relationships. Again, these red shaded bars represent recessions. And what's really interesting, not to throw cold water on a hot fire here with expectations being relatively high and optimism is extremely high in the investment markets, but you see here that when you head into, typically when you head into a trough, again, this is starting at 1985 in these 5-year increments, that you have kind of a peak, if you will, in PCE. At the same time that you actually have a trough in unemployment. And we know that we've had a very strong labor market. So you can see this relationship heading into basically the 1990 recession. And you can see that relationship was still holds true here heading into the kind of the tech bubble bursting, if you will. So albeit not nearly as stark a difference as we saw over here. Again, we go into 2008, same deal. And then we had the same situation as we head into the pandemic. And this is almost too, kind of quirky to kind of go into just because manufacture or, artificial shutdowns and things like that um, is something that's obviously not normal, but yet here we have this relationship again. Even though inflation is coming down at a relatively decent clip, and we've got a really, really strong labor market with unemployment just beginning to rise, I think we want to go into all of this, like I've said before, eyes wide open. This relationship seems to be very consistent in history as a precursor to recession. There are a lot of other things that seem to indicate recession. We've got an inverted yield curve. We had at one point 23 straight months of negative change in the index of leading economic indicators, and that recently just went positive. But again, not to sound Debbie Downer on this, but obviously we just want to be eyes wide open on what everything is telling us in the data. Here we have consumer confidence from the Conference Board. This data is published monthly. You can see that by and large, confidence here has been in a relative channel, even though the last reading represented a downtick. This can be rather noisy, but obviously it's kind of these longer term trend lines that we want to look at, and you got multiple years here, and so you got a lot of data here in 2023. A lot of data is compressed. We ended the year or started the year strong, and now we've kind of softened up a little bit. Here we have kind of a similar impact on expectations. The last reading was a little bit softer. We see a little downtrend here, but it's not at a catastrophic level. It's not cratering. So consumer expectations are important. Although I would caution that it's not expectations that you build all of your business model on. It's what consumers actually do, not necessarily what they say. But we do care about confidence. We do care about expectations. One reason why we see this kind of waver at times is the difference in gas prices. This is something that's probably, as you've heard me say, one of the most tangible ways that people feel either good or bad. If they're paying a lot higher prices at the pump, then you've got then you tend to have a little bit dampening effect on consumer confidence, and certainly on inflation, perhaps expectations as well. But we do see a noticeable tick up in gasoline prices here as of late, which may have something to do with the volatility in the expectations in the consumer data. Here we have the Conference Board. Again, it's the same group that produced the last charts for us. This is actually consumer confidence expectations. Remember, we saw that latest downtick there, and this is subtracting out the present situation. So when you think about it, mathematically, when you have a present situation that is actually better than the expectation is, then you tend to see this number go down. Again, not to sound like a Debbie Downer, but you tend to see that kind of go down as you're heading into recessions, and here we are, kind of trending down again. So everything feels really good in the market. There's a lot of optimism, a lot of positive equity flows. Again, we've been kind of I think what I would say is, through the pandemic and all these, kind of awkward money flows and injections by the Fed that have increased excess, cash balances and stuff like that, that we have kind of an unusual circumstance. But, again, if you're following the data, you tend to want to be a little bit cautious right now. You certainly want to be cautious with regard to, valuations in the market. You don't want to sound the alarm, but you want to be cognizant of what's happened in the historical backdrop. Here we have excess savings that we were just talking about. That seems to be exhausting itself. I've kind of focused on this a couple times over the last several weeks. What's interesting here, and this is BCA research, and they do a really good job, is they break it out into income cohorts. And so, when you talk about, kind of the middle group here, again, real deposits and money market fund balances have gone down. For this group, not as much, but when you talk about the lowest income groups, they're pretty well tapped out, and this represents a lot of people in our country So something obviously that we want to pay attention to. And you sashay over here, you see, kind of the stress that we see in some of these markets. You see credit card interest rates are moving higher, for personal loans, auto, and obviously we've talked a lot about mortgage rates, but you can see some of these, consumer credit rates. Think about auto loans, all the incentives that we had just really 5 years ago were, these rates were like 2 and maybe 3%. That's now punched up a lot higher. Sorry, looking at auto loans here, that's punched up a lot higher, but on personal loans, even higher. Than obviously credit card interest rates, much more than that. So as a result, we've seen credit card delinquencies kind of pick up here. We've got a bunch of these charts from the Federal Reserve, but you see, at all banks, that number's moving higher. Again, if you look at the historical backdrop going back to 1991, it's not egregious, but you have small bank credit card delinquent. These are the smaller issuers. You see that delinquency rate really picking up. So, we look at the health of the banking system and some of these small to mid regional banks, and it would seem to indicate that they're going to feel some stress, and they're going to have to prepare for that by allocating reserves against perhaps some future losses. I want to take a look at some inflation areas, because since we talked about the inflation expectation being a little bit higher on the part of economists, you can see transportation inflation here. These are various components. So you see transportation, you see shelter, and medical care. And so when you look at, basically, this component, it's higher than the overall rate of inflation, which is 3.2%. And then when you come down here to shelter, we've talked a lot about that. That's been driving a lot of this inflation. That's much higher than inflation, and it tends to peak at different times. So we saw a peak after the peak in overall inflation. It is coming down, but it is higher, and it's skewing the overall number higher because of that. Medical care, you can see here too. You've got medical care services and commodities. Medical care services inflation is actually pretty low. And then you've had a recent downtick in medical care on the commodity side. Moving forward here, forging ahead, I guess, food inflation, which was a real bugaboo. We saw that food away from home, 13.5%. We saw a real high rate of well, this is food at home. This is food away from home. You can see these numbers really trending down. You've got food at home coming down significantly. This is not nearly the issue that it was even just a year ago. And you see electricity, that's pretty much in line. And you see here energy inflation has really kind of waned. So these two items, where we would back out and getting to a core inflation number, really have come down and helped that overall figure. Here we have a drop in wage growth. This is something that I talk about a lot, and I have like individual charts for wages and then core PCE services, ex housing. This is kind of getting closer to that super core number that people like to talk about. You can see both of these kind of coming down, and this is the first time out of Guggenheim that I've seen both of these really overlaid together. And again, wages here are actually adjusted for productivity, which has actually been higher as of late. And you can see that that really does dovetail pretty nicely. And so, as we see core PCE, heading lower, we've got wages. This is all very good for service inflation, which has been really the primary driver of overall inflation over the last year. We have housing costs, have a few housing charts, and you've got again, we talk about CPI rent inflation, and then we talk about what people are actually paying in the market. And so, herein lies that discrepancy right now. And so, just to be clear, this is rent for newly signed leases. This is like in real time here. And then, so, we're seeing a decline. We've shown you that here in charts over the last several months. Rents are actually in actual decline on actual leases signed, and we've shown that data, from several different aggregators and companies in the market. So this is a real figure. Now, what's interesting here is this is basically the rent influence on core CPI, which is actually pretty high. And right now, this is at a 9-month lag. So this is the issue. So the CPI number is artificially high because of rents, and we just showed you in that last chart. Rents are we've shown you in recent charts that rents are high and they're contributing to higher overall inflation. However, it works at a lag, and so when you have observed rents that are already in a decline, it's only a matter of time before that rent comes down. And so this is the great hope, that we have for inflation hitting that 2% target. It just might take a while. We talk about credit overall. We've got a lot of indicators here. So we've got the senior loan officer survey. This is called the SLOOS data. This is their basically their estimate of tightening credit standards. And so we have credit standards which are loosening, and then we've also got credit default that have moved higher. But if you got loosening standards, the position that Guggenheim is making in this chart is that at some point you're going to have those default rates move lower, perhaps not before a peak in those default rates. Here we have tightening standards. This is basically the SLOOS data, kind of re-envisioned, but for different size banks and different size borrowers. In fact, I'm not going to bifurcate all of this data, but just suffice to say that it's all moving in the same direction. So, as it says here, a little bit different here than we see for the smaller banks, but this caption reads that basically larger banks aren't tightening their lending standards for large firms. And so that's a byproduct of this comfort level that a lot of people feel in this economy right now. Here we have delinquencies on basically commercial real estate, and you can see here the bump is on the non-owner occupied commercial real estate side. You can see that has really bumped up at a time where owner occupied commercial real estate has remained relatively steady, and so delinquencies are really coming from owner occupied properties. And I'd say a lot of it has to do with office. You see delinquency rates moving higher, and so you think about who are the lenders in this space, and it's the small and medium-sized banks. This is something that we want to continue to keep our eye on. This is something that's been developing for actually quite some time, and you can see going back to 2014. This is coming. This is just a handful of years out of the global financial crisis, and so we actually have a long way to go before we get to a real credit problem. And again, when you think about office is maybe 10 to 15% of the overall commercial real estate market, and so we do expect some stress there. But in response, what we're seeing is a lot of banks are taking increased reserves against potential losses that are implied here. This is New York Community Bank, which acquired the assets of Signature Bank, which is one of those that had failed last year. And so we see here that they've obviously ratcheted much higher their reserve for loan losses, and that was really in their earnings report what really cratered the stock here lately and added a lot of short-term fear into the banking sector. But we see here that the larger banks are increasing their loan loss reserves. We don't see that as much in the smaller to medium-sized banks. They're kind of like plodding along here. And I do think that this is all going to move a little bit higher just because banks need and probably will want to be conservative heading into the next year. On this slide, we have some information on durable goods and capital goods orders. These are larger ticket items that give you a good barometer for where the economy's at. We can see here on durable goods that the actual number reported for February is a little bit better than expected. We see that in the red bar here, so that's positive. Data's been a little bit noisy over the last 6 months or so. And this is durable goods X transportation. Now, if you go a little bit, slice it a little bit different way, you got capital goods orders that are non-defense, and you take out aircraft, which can be really, really lumpy. On a month-over-month basis, you can see that that was also positive, again, with a relatively noisy backdrop here over the last 6 months. What we have here, though, even though we do see some positive trends, if we sashay over to the right, we've got, over here, we've got goods orders versus shipments. We see that basically we've got orders that are below shipments and have been for a number of, for quite a few months, actually, over the last year or so. And so we can see that down here, that if you have orders less shipments, I mean, this is a function of maybe people, while in other areas of their financial profile, feel relatively good about the economy, just from a stocking standpoint, or even from a capacity utilization standpoint, people are a little bit more cautious here. And so obviously we want to see that turn around. And you can see, going back to 2017, the ebbs and flows, and then the pandemic shutdown, and then we have this huge boom in capital goods, and we knew that manufacturing is very strong coming out of the pandemic. You can see that here, and then that naturally is going to kind of mute itself out over time. And so we're at a point here on manufacturing where we're still kind of working our way through this whole process, and eventually to get to a better place. Got a lot of data on this page. A lot of it says really the same thing. So just to be clear, this is manufacturing data from the Richmond Fed, and this is from the Dallas Fed. These are two areas of the country that are obviously very important to manufacturing. And what they tell is really the same story. And so what we saw on the manufacturing index in both cases was something that was less than what the market had expected. And manufacturing, as we've kind of talked about, over the last month or so, it hasn't gotten materially worse. It's just struggling to get better, and we see that both in Dallas and Richmond. You look at new orders here. This is what we were just looking at that prior slide. I mean, it's still in kind of a weak position. We got a little bit of a head fake here recently, I'd say about a few months ago, in this data, but it's still by and large weak. Now, to kind of flip the coin here, we're looking at Philly Fed data, and we're looking at non-manufacturing. So this is all manufacturing over here. This is services, and we see that in Philly Fed, the service related index is a little bit weaker. So again, to the point of being eyes wide open to the data and being very cognizant of what the developments are, is going to be very important heading into the latter half of the year. So we talk about the labor market. This is, again, Conference Board. This is a survey question. This is jobs plentiful, less hard to get. And so obviously jobs are a little bit easier to come by. We've seen a noticeable uptick here in 2024. So, we're not necessarily at pre-pandemic peaks, but we're very close. So this is a fairly good sign. Again, labor remains fairly in a fairly good spot. So jobs are a little bit more plentiful. We'll talk about housing for a little bit. This is the Case-Shiller 20-city composite home price index, and you can see, where we are now is we're seeing basically a deceleration in the rate of growth in home prices, although they're still positive. We did see a period in 2022 where those home prices were going down, but that was coming off a period of just completely insane price increases. And so we see that, the amplitude of these things kind of leveling off, and you could probably expect to see something like that going forward. But home prices continue to move up, but at a much, much slower pace. We have a chart that from Redfin that was reposted in Liz Ann Saunders' social media post, and I thought it was really interesting. It actually shows you the impact of those home price increases as we go, we went from 2022, 23, 24. At the trough, basically the typical household was making about $40,000 less than was required to afford a medium priced home. Again, that's not a starter home. That's just it means that half of the homes are above the median and half the homes are below the median. And so the median home was very difficult to afford. So housing affordability remains a problem. It's a little less so than it was. Now it's only like 30,000 instead of 40,000, but it's housing affordability is still an issue. Here we have median sales price. So this is basically off the peak. And so I think this is important from the standpoint that, we looked at what happened in 2022 and then, obviously 23, and then we see home prices are still moving higher, but they're decelerating, but they are almost 20% off their peak, which is notable for a lot of reasons. And then we have seen here relatively recently, this is data as of about March 17th, so it's kind of just only a couple weeks old here. But we do see the percent of listings that had price drops has picked up at a time where we generally don't see that as much in the marketplace. Got the size of new single-family homes. This is actually came up in kind of a policy discussion for the city that I happen to serve on the city council of, and talking about the over time, when economic conditions are more favorable, or easier at least, you tend to have kind of an increase in home size, right? Because affordability is higher and so on and so forth. And you had a global financial crisis here and that reset the bar, but things got a lot easier then. And then as we got into the latter half of last decade, and the trend has really continued, it's just like the average size of single family homes has continued to come down. And so that has something to do with home prices when you look at it on the average. I'd say size absolutely does matter. And in this case, we clearly see that the size of new single family homes is coming down. People are building smaller units that with more density within the development, and it's just kind of a trend that we're going to have to be cognizant of. Now we're going to switch over to the investment markets. The confidence factor remains extremely high. We see the percent of S&P 500 members above their 200-day moving average, and this is technically an indicator of the strength in the market. Right now, we've got almost 85% of the index constituents that are above their 200-day moving average. That's very healthy if you're looking for a strong market, but it also could indicate a little bit of froth. And we see here in basically the options on the VIX, which is kind of like a second derivative of volatility. See, overall volatility is just really low. So you got high confidence right now at a time where volatility and complacency is very, very low. So here we have basically the fixed income markets, and this is an indicator. This LQD, may seem pretty abstract to most of you, and I understand that, but basically it's a measure of volatility for investment grade corporate bonds. And just like we saw in equities, volatility is falling through the floor here. So 2024, not much volatility. Again, it doesn't. It pales in comparison with what we saw before the pandemic, but from a credit standpoint, I should say that really over the last couple of years, we've seen a dramatic decrease in volatility, which also indicates some degree of confidence in credit, even though we've seen some a small rise in bankruptcies and so on and so forth. Here, this is interesting because this is basically the investment grade credit market, and what we've seen here, looking at it over the last couple of years, is that the amount of triple B, which is still investment grade, but it's less credit worthy than single A would be, but you've seen a rise in higher grade credit within the investment grade credit market, and you've seen a gradual decline in some of the the more marginal investment grade bonds. And so the quality and the texture of the investment grade corporate bond market has really improved. Now we'll talk a little bit about insider selling, because what we've seen here as of late, at least for technology firms, with the NASDAQ continuing to move higher, is that we've seen a real rash of insider trades. Now this, for the longest time, was a barometer that we use to gauge kind of overall, what insiders thought of their company prospects. And oftentimes you'd see a spike of insider selling, before prospects began to roll over, and we saw earnings, kind of roll over. But, in this case, I think it has more to do with valuation than really anything else. But, you can see that, this has kind of like vacillated over time, but it's kind of picked up over the last really couple of years and just accelerated in the last, in really the last few months. Valuation is certainly important in looking at it with the backdrop of the optimism that I've just shown you in the market. We've got two different ways to look at it here. So in the first chart, we've got the proportion of U.S. stocks with a price to earnings ratio above 30, which I would consider to be stretched, right? And so, the percentage right now is about 23% of the S&P 500 has, a PE of greater than 30, which if you go back to 2000, the average is here about, about 18%. And so having 23%, is it way out of line? No. Is it higher than normal? Absolutely. So if we go back to this chart on the right, this is the U.S. median price to earnings ratio. So again, half the companies in the stock universe have a price to earnings ratio above or below this. And so the median price to earnings ratio right now is about 17.5 times, which actually is just perfectly in line with the long-term average. So you think there are stocks that are overvalued, which kind of skews this a little bit higher, but the median U.S. stock is actually pretty much directly in line with valuation. So, are valuations stretched? Well, for the vast majority of stocks, the answer is actually no. For some stocks, I would say yes, but unfortunately, some of those stocks that are most apt to be overvalued are highly influential to the index, and that's why I say the prospects of a near-term kind of pullback reset are relatively decent, just because I think the potential volatility in those larger stocks is real. So we have a chart here that shows you the S&P 500 PE. If you back out the Magnificent Seven, we showed you in that last chart that basically the median number of all stocks in the universe of tradable stocks in the country is about 17.5. But if you look specifically at the S&P 500 and you back out the Magnificent Seven, we do see a valuation increase. And this is a function of basically the market from, basically from October, the October trough here, to the present. And you can see that those multiple expanded from about 15.5, which I would argue is actually pretty attractive, to 19, which is certainly less so. And this is kind of the noise that was generated out of the pandemic shutdown. But you can see, like, relative to history, and this goes back to 2016. If you go back a little bit further, that average is going to be right around here. So I think we're a little bit higher just when you look at the S&P 500. Again, this is not the median number that we were looking at in that last slide. This is just basically the S&P 500 if you just simply strip out the Magnificent Seven stocks. Well, that will do it for the chart pack this week. Hope you've enjoyed it. Have a great week. And for those who celebrate, happy and blessed Easter. And we will talk to you again soon. Take care.